Thanks a
pages.
lot, Pamela. I want to add one thing. Pamela was talking about liquidating partnerships, one of the pitfalls. It comes up so frequently, almost all the time, every day. And if you have a situation like that, you get with Pamela as early as you can in your exchange because you want to get ahead of that. So, okay, what I'm going to talk about today is the DST, but in particular, a short form presentation focusing on the fee structure. I get a lot of questions on what is the cost to the investor when you invest in a DST. I'm going to take you to some pages out of a memorandum. We don't name sponsors. We don't name deals. This is not an offering. But what I'm looking to do is show you what you might see if you look in a memorandum and how you can actually calculate the fee and the cost to you in an investment in a DST. So the first thing I'll do a little background on the DST just for a minute for those that may not be familiar, some of the risks and benefits, and then we're going to get into the fees. So essentially, the Delaware Statutory Trust is a co-ownership structure. It's a passive investment. The IRS recognizes this. Rule 2004-86 revenue ruling recognizes the beneficial ownership in a DST as ownership of the real estate that the DST owns for the purposes of the 1031 exchange. So it's black and white in the tax code. If you invest in a properly structured DST, you will defer your taxes. It's a co-ownership structure, so there are other investors, and it's a passive investment. So you don't have control over the investment. It's really for people that are looking to get away from management responsibility. Those are the customers, the clients that call me who are looking to get into a DST. They don't want to manage real estate anymore. Real estate investment company, the sponsor will acquire the property. They'll put the financing on it. They're going to manage the property. They're going to manage the overall asset. Your involvement is collect your rent revenue. You know, what's left of you after all expenses is a cash on cash return to the investor. DSTs can own single properties. They can own portfolio of properties. They can eventually be converted into REIT shares. There's a lot of options there. You know, we're going to get into those things in more of these smaller, more focused presentations. There'll be a whole series of them. So just to touch on some of the risk, you don't have control. I always say if you're going to be a passive investor, work with a good quality sponsor, best sponsors, extensive track records, let them control the asset, let them make the decisions. So in one regard, it can work in favor. Back in the day when we used to do TIC investments and people had a vote, that's what could hurt a deal. Some unsophisticated investor has a vote, doesn't want to go along with what the sponsor wants to do, and they can't work out a deal if there's a problem. So no control, they're illiquid. You can sell your interest. However, there's no secondary market for it. But the real risk is just the real estate risk. If you go out and buy a property and your occupancy drops and your cash flow drops, well, the money that you take home is going to be less, right? If you're paying a note and occupancy drops, you can't make your loan payments, you're in jeopardy of losing your property. Stuff like that can happen in a DST. Again, why we try to work with sponsors with extensive track records. This is a list. You know, I'm not going to go through the whole thing here because you're going to get a copy of the presentation. There are some prohibited actions, and you want to make sure that you're working with sponsors that follow these rules, because this is where the IRS could come in and invalidate a DST as not being properly structured. You can't raise new money. You can't take on new debt, restructure a loan, things like that. So there are important things to know. The reason why I'm just passing through it is because I want to get to the fees. The fee structure in the DST. It comes up all the time, and it's just not as black and white as looking at a line item in the memorandum. We're actually going to look at a couple of pages from memorandums from older deals. We don't name deals, we don't name sponsors, but we're going to look at a page called the estimated use of proceeds. And I'm going to jump ahead here to one, and looking at this page right here, and we see a lot of numbers on this page, and we see a lot of percentages, and we see that it all equals 100%. But if you can tell me what the load is, and that's the fee, the load on this deal, just by looking at this page, I commend you. But what I'm going to show you how to do is really find out the true cost to the investor using a simple calculation. we're going to use some simple numbers here. We have a total offering amount, which is your equity. That's the money raised from the investors. And this is the debt. This property has debt on it. That's your total offering amount. We're going to look to the reserves right here, this number, because that's not a fee. That's your money. If it's not used to take care of the property, it'll come back to you when the property eventually gets sold. So we back that out of the equation as far as a fee to the deal, because it's just like if you bought a property and you put some money aside to take care of the building, that's what this is. And we're going to look at this number here, which is the acquisition of the real estate. So going back to, we have two cases here. This is the one I was just talking about. We had a total offering amount of equity and debt of this $68,172,000. We have that reserve account, and then we have a net offering price. So it's as simple as this. The other number I told you we were going to focus on was the acquisition of the real estate in the deal right here. We're going to take that net offering price after we back out the reserves, and we're going to subtract that acquisition price. And here's your load. There's your fees right there. We're going to divide that by the acquisition price. We come up with 7.66%. Now, if I go back to the estimated use of proceeds page, I don't think you see that 7.66% anywhere. Okay, but that is the cost to you in this deal, and that is the amount that this property has to appreciate by to overcome the load, to overcome the initial cost of getting in the deal before you're going to be profitable in that deal when that property eventually gets sold, and it will get sold. So simple way, you go to the estimated use of proceeds page in the memorandum to get that information, but just looking at the percentages here, it's hard for you to tell what's the actual cost. Now we're going to go to another one here.
Eric, where did you get?
We'll go back to the other slide and I'll show you case 2. Eric? This one right there in bold, here's your total offering amount, your offering proceeds, which is the equity being raised, and then your debt. We have the acquisition cost here, and we also have a few different line items for reserves. We got a lender reserve escrow, we got a master tenant reserve, and we got trust reserves. Now, for the purposes of this illustration, I grouped all those numbers in together as one reserve, but we would want to do some further due diligence on a deal like this to see exactly why this money is separated like this, and where might it be going, and how might it be used, and could it at some point go to the sponsor if the money was not used for the property. So again, the three numbers, the total offering, the reserves, and then we had the acquisition of the real estate right here. And we're going to go back. We're going to go back to case 2. So we had that total offering amount, and then we had the reserves. Now look at this, much larger property, 101 million, and much smaller reserve account. So there's a difference right there. If that reserve money runs out 4 or 5 years down the road, and then the property needs work, something unexpected comes up, where are you going to get the money? This is where you rely on your advisor to vet these deals and help you to see how that would work. You know, you look at a less expensive property here with a much higher reserve cap. There's different reasons for that, and there's a lot more that goes into vetting a deal, but just pointing it out. So looking here, your net offering amount after you back out those reserves minus your total acquisition price. Now here's your total load, and then you divide that by your acquisition price, and you got 14.196%. So that's a stark difference to the 7.68. Now listen, each one of these deals should be vetted on their own merits. You know, there are different things that go into a deal. What was the this acquisition of 87,500? Did they get a really good buy? I don't know. You know, we're not doing that kind of analysis right here. I'm just showing you how the two different deals look and how these fees are structured. And so this 14.19%, that's what this property has to overcome in order for you to be profitable when this property eventually gets sold. So, you know, it's called the estimated use of proceeds page. All the information is there. You just have to pull it and do a simple calculation. And this is the second one for case 2. And then, you know, just for kicks, I threw in another one. And This one here, came from what I call a tertiary sponsor. I work with mainstream sponsors that have extensive track records, 20 plus years in the business, hundreds of deals they've gone full cycle on. You stick with those sponsors when you're doing a passive investment, and you're going to sleep better at night. But occasionally, we look at everything. I don't want to be so stringent that I don't look at other opportunities, and this deal came across my plate. So the first thing I noticed was some numbers were missing, and this is my handwriting here. And adding it up, this is the percentage of the equity. I just brought the numbers over, the percentages, and we came to 11.14 there, and then an additional 10.2. This deal had egregiously high fees, and really we didn't look much past that. But what was more important was the fact that it looked like it was kind of deliberately left out, and another reason why we probably wouldn't work with a sponsor like that would do something like that. So I see 12:39. We started at 12 o'clock, 40 minutes. I appreciate everyone coming. These presentations are going to be on my website.
Wait, don't go away. Can you hear me?
Yeah.
Can you hear me?
Yeah.
Yes. Okay, don't go, everybody go away. So there was a question, where's Eric's contact information? It is right here, okay? Also, Eric or I will be sending you our PowerPoints in PDF format. And I think Eric will also be sending you a video. I'm trying to get my video back up, but never mind. Let me just see, Eric, before you exit, you were so fast and I was so slow. Let's just see what the chat, let's see if we have anything to answer here other than administrative difficulties. Yeah, okay, it's all about the administrative. Okay, so contact information for Eric is here. Again, we'll be sending out the slides. You'll have Eric's contact information on the slides. And, Eric, I think that was a fabulous presentation on the fees and costs and how you analyze it. I just want to throw a couple more points in on Eric's end of the transactions. That was a great analysis of fees, but there's so much more that goes into analyzing the property. And Eric can help you through that process, because that's what a broker dealer is supposed to do. I cannot tell you the number of questions I get on the DSTs, and I have limited knowledge, and I'm not really the one that's qualified to give the expertise. So I'm going to refer you, and please go to these people well in advance of selling your relinquished property, because in addition to the fact that Eric's so knowledgeable, it's a fast close. If you're going to buy DSTs and you're going to buy DSTs, you can actually finish your exchange in your 45 days, which is your identification period. So Eric, you want to say anything a little more?
Yeah, a couple of things. So a question came in, Elliot Burke. Can a small family-owned corporation add shareholders between the time of sale of relinquished property and purchase of replacement property? That's a question for you.
Yes.
And I don't know if you want to try and answer them right there.
Yes. So you can't change the tax owner, but with a corporation, the corporation's the tax owner, and shareholders can come and go and you don't have a change of tax owner. With a partnership, partners can come and go and you don't have a change of of tax ownership. With an LLC that's taxed as a partnership, the same rule applies. The only exception is if you have an LLC and so many partners exit that you're left with one member, now you've changed the tax owner. So sometimes this happens with the PIN structure, partnership installment note. And in that case, where maybe we have two partners and we want to take one out in a form of a note, we're going to say that you need to bring in another person for 1%. At the same time, you take out the other partner so that you at least have two partners in the partnership or in the LLC, two members, so that the tax owner stays alive. I don't know if that answered it. Okay. That was another,
so there's another question. How much is Eric charging for brokering for a DST? So again, that's on that estimated use of proceeds page. It's a part of an offering, so it's all built into the deal. I don't charge you anything directly. Your fee is incorporated into your purchase price. And you'll see a line item in the estimated use of proceeds called the selling commissions. And that's the part that goes to my broker dealer that will eventually, a share of that will come to me. So it's all built into the deal. It could be 3, 4, 5, 6% of the equity. A lot of the deals are different. Another question was, how do you find a quality DST? That's your advisor. That's my role. Again, 20 plus years doing this. I'm one of maybe 3 people I know in the country that could tell you they're doing this for more than 20 years. And we know how to vet the deals, myself and my broker dealer. And we work with the quality sponsors. And we think we do a good job of weeding out the bad deals. And the last thing you want to do is the Google search and just find something. And that's how you find the bad actors. You want to work with a referral with an advisor, like the way Pamela might refer someone to me.
Also, Eric and I have worked together, I think, more than 15 years now. I've been in the business for over 20, and Eric the same, I'm sure. Let's take this one more question. I understand that an LLC is different because it is a disregarded entity. That is not the case. An LLC is only a disregarded entity if it is a single member LLC and the tax returns are filed in the name of the sole member. You could have an LLC that is not disregarded, even though it has one member, and it's taxed as an association like a corporation, which is very rare, but it could be the case. So just having an LLC does not mean it's disregarded. If you have an LLC in the Northeast and husband and wife are the members, the LLC is the tax owner. We are not a community property state, none of our states in the Northeast. So the LLC is regarded. So just being an LLC does not mean it's a disregarded entity. And disregarded, for those that don't know, is an entity that is not recognized by the IRS. The IRS doesn't see it. So if an LLC has one member, John Smith, and the property appears on John Smith's personal tax returns, that is a disregarded LLC, which means the IRS does not see the LLC. It's on title, but that's it. Here you go, Eric. This question's for you. How long is the DST investment period? 10 years?
No, well, so I don't know where they get the 10, but that was a good guess. So the loan terms are usually 10 years, and the property will likely be sold before the end of the loan term. And the best way for me to answer that is to offer you historical holding periods, 5 or 6 years, and these deals will roll over. And then you'll start right where you were in the beginning. You can do your own exchange. You can take your money back and pay your tax. You can do another DST investment with the same sponsor or any other sponsor. A minimal investment in a DST is $100,000. I've done it for 100,000. I've done it for 10 million if the equity is available. So it all depends on the exchanger and what they're looking to accomplish. It's a great way to fill the gaps when you have some leftover equity. If you bought a property on your own and you want to fill the gap and not have boot, use that leftover equity into a DST. So historical performance different for every deal. It'd be inappropriate to just blurt out a number, but in the back of every memorandum is every single deal that every single sponsor ever did. And we can get the track record of any sponsor historically, what their returns have been. Loan to values are typically around 50% right now, a hair lower right now. We're actually seeing it's a challenge because most people do have debt to cover, and the lower LTVs were, didn't have enough debt to cover those LTVs on their relinquished property. But yeah, maybe around 50%.
And there was another one right before this one. Does the DST qualify for a step up on death? Yes, it does. It's like real estate, just like everything else, just like any other
asset. Yeah.
And then, so if the LLC is not disregarded and has multiple members, then it too, like a corporation, can change members between sale of relinquished and purchase of replacement property without losing the 1031 qualification. Yes and no. So you can change your members, but if you use proceeds to buy them out, then you can have a problem. And if you convert them to a tenant in common, you change the tax owner. So usually if you're taking out members in an LLC, you'll see somebody does a drop down and they take out that member by converting them to a tenant in common, which just doing it on paper doesn't make them a tenant in common, but that's a discussion for another day. And so you have taken out that member, and the question here is, have you now lost the 1031 qualification? Will you just change the tax owner? So you have a risk. And that risk is that the IRS could say, we're not going to recognize that you converted one or more members to tenants in common, and anything they received, we're going to say is the profit and proceeds attributable to the partnership sale, and tax the partnership if it was not used in the exchange. So it's not that easy. It just, you can't, the examples I used was corporation. And I did say you could add and subtract members of an LLC without changing the tax ownership, unless you ended up getting down to one, and then you would have a change of tax ownership. So you can, the short answer is you can change the LLC members, but you can't use proceeds to pay them out, and you can't take them out via changing the ownership structure from LLC to tenants in common. They can leave because you've used other proceeds to buy them out, and you redeem their membership interest with other proceeds, and the LLC remains the only entity on title, and there's no tenant in common structure. But the minute you convert from an LLC to tenants in common, you have changed the tax owner. Okay, that was a very long answer to a short question. How about an annual report from the DST property, Eric?
Yeah, so we get quarterly reports, we get annual reports, we get the year end. It's not a K1, it's not a 1099, it's really a year end statement that you can just hand to your accountant. Everything that you need, all the information you need will be on that. If you're asking for a sample of an annual report, you can reach out to me directly and I can provide that. But the reporting is done quarterly and annually, and the tax reporting usually comes in. The stuff you need for your taxes usually comes in by the end of February. And then there was a question, what are the typical tax implications? So I guess that means the income tax. So it's ordinary income. So that depends on the investor and what bracket they're in, but you're going to pay federal tax, you're going to pay state tax. So look, if you live in Florida and you buy a property in Florida or Texas or Nevada or Tennessee, you're not going to pay any state income tax. If you live in New York and you buy a property that's in Florida, you're still going to pay your New York tax, right? A lot of people don't understand the way that that works. You're also going to have to file, if necessary, in the various states where the DSTs own the property. If there's no state income tax, you shouldn't have to file. If you're below certain minimum filing requirements, which is often the case because you're buying a percentage of a deal and your income ends up being, you know, a much smaller amount than the whole deal. So yeah, you would potentially have to file in other states.
There was one more up here. You stated that there's a step up on death. Do the sponsors cooperate on the date of death valuation, not just step up, but for estate purposes?
Yeah, so that's a good question. And that's going to be a little more challenging to get that valuation. The sponsor will cooperate to the extent that they can. I don't think they're going to go out and get another appraisal, but they will calculate cap rate, and by way of that cap rate, you know, based on the current revenue, and then by way of that cap rate, come to a projected valuation. And yeah, and that's something that your advisor, who would be me, and the sponsor can work on with you together. But you know, we'll come to that conclusion, but they're not going to like get an appraisal. I actually think the cap rate method is better and more accurate. Yeah, they'll help you find that out.